The Supreme Court just dropped a nuclear bomb on the White House's economic playbook. 6-3. That's the count that just changed the rules for every ounce of silver on Earth. The president's power to tax the world is gone, and the silver market is reacting with a violence we haven't seen in decades. From a $121 peak to a 50% collapse, the game is rigged, the vaults are empty, and the law just changed. You need to see this. Tuesday, February 24th, New York time. Drop your date in the comments below so I can see where you're watching from. And if this kind of reporting is valuable to you, hit subscribe and drop the words George Williams in the comments. It genuinely helps more than you know. Now, let's get into it. 6 justices against 3. That was the final count when the U.S. Supreme Court delivered one of the most consequential financial rulings in recent American history. The court struck down President Trump's reciprocal tariff program, the sweeping set of trade penalties that had been reshaping global commerce since early 2025. The ruling didn't just clip the White House's wings, it ripped them off entirely. And markets, currencies, commodities, they all moved at once. But silver? Silver moved in a way that tells you something much deeper is going on beneath the surface. Something that one court ruling cannot fix. And frankly, something that one court ruling may have just made significantly more complicated. Let's talk about what the court actually decided, because you need to understand this before anything else makes sense. The justices ruled that the executive branch had overstepped its constitutional authority in imposing broad reciprocal tariffs without clear and specific congressional approval. In simple terms, the president cannot unilaterally tax the entire world's goods coming into America under a vague national security or trade emergency umbrella. Congress holds that power, and Congress, for all its dysfunction, had not explicitly handed that power over. The 6-3 split tells you this wasn't a partisan slam dunk either. This was a serious legal argument that found majority support across ideological lines. That matters. It means this ruling is likely to hold. Now, why does a trade ruling make silver move? Because tariffs are not just taxes. They are the architecture of global supply chains. They determine where metals are refined, where they are shipped, where they are stored, and ultimately, who pays what price for them. When Trump's tariff structure was in place, silver was being hoarded in American vaults at record rates. Traders, miners, and industrial buyers were front-running the tariff system, rushing physical silver into the U.S. before import costs exploded. The moment that structure gets legally dismantled, the calculus changes overnight. Silver sitting in American warehouses suddenly becomes less strategically necessary, and that uncertainty, that repricing of where silver needs to be and who needs to pay for it, hit the spot price immediately. As of today, silver is trading at approximately $88.04 per troy ounce. That is down 0.98% on the session. On the surface, less than 1% sounds modest, but you have to zoom out to understand the full weight of that number. Just 26 days ago, on January 29th, silver hit an all-time high of $121.67 per ounce. 26 days. And from that peak, it crashed, hard, all the way down to $63.85. That is a collapse of nearly 50% in a matter of weeks. One of the most violent price swings in the history of this metal. And now it sits at $88, trying to find its footing, while a Supreme Court ruling reshapes the entire trade environment around it. You cannot look at today's 0.98% dip in isolation. You have to see it as part of a much larger, much more volatile story that is still being written in real time. So what does the Supreme Court ruling mean for the bigger picture? It means the United States just lost, at least legally, one of its most powerful economic pressure tools. The dollar's reaction matters here. A weaker trade stance tends to weaken the dollar, and when the dollar weakens, hard assets like silver and gold because they are priced in dollars. A cheaper dollar means cheaper silver for international buyers, which increases demand, which supports price. That is the basic mechanism, but it is not that simple today, because the market is also digesting what a world without these tariffs means for global trade flows, for manufacturing, for the supply chains that silver is embedded in at every level: solar panels, electronics, electric vehicles, medical equipment. Silver is not just a financial asset, it is an industrial backbone, and disrupting the trade framework that governs its movement creates uncertainty in both directions. Here is what most people watching silver right now are not paying enough attention to, and it might be the most important thing I tell you today. The COMEX, that is the Commodity Exchange in New York, the primary marketplace where silver futures are traded, is sitting on a physical silver inventory that has collapsed by 75% since 2020. Let that sink in. In 2020, COMEX had approximately 346 million ounces of registered silver. That means silver that is actually in the vaults, tagged, verified, and ready for delivery. Today, that number has fallen to roughly 88 million ounces. And here is where it gets alarming. There are currently 5 paper claims, meaning futures contracts, obligations to deliver silver, for every single physical bar sitting in those vaults. 5 to 1. That ratio is not a warning sign. That is a structural crisis waiting for its trigger moment. In December alone, 47 million ounces were claimed for physical delivery in just 4 trading days. To put that in context, the historical norm for an entire December delivery cycle is somewhere between 10 and 20 million ounces. Nearly 3 times the normal volume was demanded in less than a week. The system is being stress-tested, and a Supreme Court ruling that reshuffles global trade flows does not make that stress test easier to pass. And then there is Mexico, the world's single largest silver-producing nation. In 2024, Mexico produced 202.6 million ounces of silver, more than any other country on Earth. Right now, that production is being disrupted by civil unrest, with cartel activity and instability creating operational chaos at mines across the country. That is over 200 million ounces of annual supply under threat. When you combine a 75% drawdown in COMEX inventories with disrupted supply from the world's top producer, you are not looking at a supply tightness story. You are looking at a supply emergency that is being held together by financial instruments and creative accounting. For now. Now, let me give you the other side of this, because honest analysis demands it. The silver bull case has taken a real hit from a direction most people did not see coming. Solar energy, one of the fastest growing sources of industrial silver demand, is starting to move away from the metal. LONGi Green Energy, the world's largest solar panel manufacturer, has announced plans to replace silver with copper in its back contact solar cells, with mass production expected to begin in Q2 of 2026. That is just weeks away. Jinko Solar has made similar signals. Shanghai Eiko Solar Energy has already launched silver-free solar cells. Why? Because silver now accounts for somewhere between 17 and 29% of the cost per watt of a solar panel. That number has surged as silver prices climbed. When your biggest industrial customer starts engineering you out of their product, that is a demand shock. It will not happen overnight. The transition takes years, but the direction is set. And market's price direction, not just today's reality. So you have 2 enormous forces pulling against each other. On one side, a physical supply crisis. COMEX vaults draining, Mexican production disrupted, 6 consecutive years of supply deficit in the silver market. 6 years. The market has consumed more silver than it has produced every single year since 2019. That deficit doesn't disappear, it accumulates. Above-ground stockpiles are being drawn down year after year. On the other side, you have the world's largest industrial silver consumers beginning a multi-year substitution away from the metal. These forces will collide. The question is, which one dominates the price in 2026 and beyond? The Federal Reserve adds another layer. Right now, markets are pricing in approximately 60 basis points of interest rate cuts from the Fed by the end of 2026. In plain English, that means traders expect the Fed to lower borrowing costs, likely across 2 separate cuts throughout the year. Lower interest rates are historically very good for silver. Why? Because silver, like gold, pays no interest. When rates are high, money flows into bonds and savings accounts that pay a return. When rates fall, the opportunity cost of holding silver disappears. Suddenly, a metal sitting in your vault looks a lot more attractive than a bond paying 3%. Rate cut expectations have been one of the quieter support mechanisms holding silver above $80, even after its catastrophic collapse from $121. This week, that Fed story gets a major update. U.S. jobs data and inflation figures are due for release, and those numbers will either confirm or shatter the rate cut timeline. If inflation comes in hotter than expected, rate cuts get pushed back, and silver loses one of its key supports. If the data is soft, rate cuts get pulled forward, and silver gets a fresh tailwind. This week's data is not background noise. It is a potential price-moving event in its own right. JP Morgan, for all its analytical firepower, is forecasting an average silver price of $81 per ounce for 2026. That forecast is already behind the curve. Silver is trading $7 above that average right now. But JP Morgan's logic is not crazy. They see the solar substitution risk. They see the speculative excess that drove prices to $121. They see the possibility of another round of margin hikes at exchanges triggering another flash crash. Their $81 target reflects a world where the speculative premium gets wrung out and industrial demand growth slows. The problem with that forecast is that it does not fully account for what happens if COMEX actually fails to deliver. It does not account for a scenario where a major buyer shows up demanding physical silver that simply is not there. In those scenarios, $81 looks like a distant memory. Here are the key price levels you need to keep in your head right now. On the upside, the first real test is $92. That is the 0.382 Fibonacci retracement level from the all-time high, and it is the first ceiling silver needs to break through to signal serious recovery momentum. Above that, $100 is not just a psychological round number, it is the 0.5 retracement level, and reclaiming it would send a very loud signal to the market that the January crash was a shakeout, not a top. Beyond $100, the next meaningful target is $109. On the downside, $81 is the first major support, coincidentally right where JP Morgan thinks fair value sits. Lose $81 and $73 comes into view. Lose that, and $65 is the next floor. Below $65, the bear case gets very ugly very fast, with some technical models pointing toward $48 as a worst-case scenario. So what actually happens next? The bull case is straightforward. The Supreme Court ruling weakens the dollar, rate cuts arrive on schedule, the COMEX supply crunch worsens, and silver reclaims $100 and pushes toward $109 by mid-year. The bear case is equally plausible. Solar substitution accelerates, inflation data this week kills the rate cut narrative, speculative money exits silver for other assets, and we retest $73 or lower. But there is a third scenario, the wild card, and it is the one that keeps serious silver analysts up at night. What if COMEX is forced into a delivery failure? What if a major institutional buyer demands physical silver and the inventory simply cannot cover it? That event, if it happens, would not produce a 10% price move. It would not produce a 20% price move. History suggests that kind of supply shock in a physical commodity market produces the kind of price spike that rewrites the record books in a single session. The Supreme Court just changed the rules of global trade. Silver felt it today, but the forces building beneath this market, the drained vaults, the disrupted mines, the solar industry's pivot, the Fed's next move, those forces were already in motion long before 9 justices cast their votes. And what those forces do next is the only story that matters.